Hello and welcome to the Mint Funds and Market Update for July. My name is Ryan Falls and I will take you through the diversified funds performance as well as a recap on what happened in markets over the month. So starting off with inflation, we can see inflation continues to moderate globally. What we're looking for is all these various lines in this chart to trend down to the bottom right-hand side towards that 2% target line. So this is typically the central bank target for what they would like to see annual inflation at. Some central banks define it as a range between 1% and 3%, but generally of all these economies, New Zealand, US, EU, all seem to be trending down the right direction. Now there is one exception in Australia, which has seen a slight increase in inflation for May of 4% versus an April reading of 3.6. So everything's going the right direction with the exception of Australia. Now, turning to the labour market, specifically the labour market in the US, we can see it is starting to creak a bit. So labour market slack is increasing as businesses both unwind their COVID hiring and also react to a weakening consumer. And the way they're doing that is by adjusting their labour force. So looking at this chart on the left-hand side, we have US job openings. So this is a measure of all unfilled positions on the last business day of the month. And as we can see, obviously, during a period of abnormal job growth post-pandemic, it appears we're coming back to the pre-pandemic trend with that green line trending down. Turning to the chart on the right, we have US job workers gap. So this is effectively a measure between labour demand and labour supply as a percentage of overall labour supply. So effectively, when that line goes above zero, it effectively implies there's a labour deficit, aka there's not enough people to work for the amount of jobs on offer. And then obviously, if it goes below that line, it's the opposite. As we can see, post-pandemic in 2021, we had quite a substantial labour deficit as a result of high aggregate demand. And since then, we've seen through, I guess, labour market normalisation, the labour markets now, the job workers gap is actually trending back towards that zero line, so being in, I guess, equilibrium. In June, equity markets continued to storm, so the S&P 500 hit its all-time high again in June, and then subsequently again in the start of July. The AI theme still dominates, however, there is expected levels and expected market volatility is going to increase as we get closer to the election in the US. Looking at the S&P chart, you can see it is up and to the right, so price of the total index is going strongly. However, we are seeing the AI theme starting to broaden, and other sectors are actually starting to show some signs of outperformance, particularly looking at defensive sectors like utilities. On the right, we just wanted to show this chart, which shows the change in market implied odds for the 2024 presidential election. As you can see, it's the debate that happened earlier this month or earlier in June caused quite a rebasing of expectations for who markets and betting markets believe will be in the White House post-November election. But either way, what this means for markets is that there will be a substantial increase in volatility and risk around that event. Turning into bonds, they're holding up. So bond markets keep swinging back and forward as interest rate expectations shift from overly optimistic to overly pessimistic on each and every new data release. What you can see on the left-hand side here is the market implied Fed rate by the end of this year's 2024. That red dashed line shows the current Fed funds rate. So as you can see, there was quite a substantial rebasing. If you think that each increment on this chart of 50 bips is effectively 2 cuts, you can see that there is circa 2 cuts priced in now by the end of this year. And that was as at the end of June. And that's obviously quite vastly different to what it was at the start of this year. So markets are grappling with between being that overly optimistic, thinking lots of cuts are going to happen, to overly pessimistic, thinking no or little cuts are going to happen. Looking at the right-hand side, we have this chart which shows the junk bonds, aka high-yield bonds, are pricing in a soft landing. And what this shows and tells us is the credit spreads remain tight, and as a result of investors trying to lock in those attractive high yields. So if you take both the high interest rate plus the credit spread, that's an attractive yield for an investor. So people are keen to lock that in for a number of years. What the red dot shows in this chart is that the implied default rate is actually much lower than the trailing 12-month default rate, saying that investors are willing to pay up and pay more for access to these all-in attractive yields, even if defaults appear to be rising slightly. Turning now to New Zealand, so there was some positive news in June. So GDP for Q1 bounced marginally back into positive territory. So what this means is New Zealand is no longer in a technical recession. However, this does not mean that New Zealand economy is out of the woods. And this is a comment based on the sentiment that it remains quite downbeat, both consumer-wise and also businesses alike. So looking at the right-hand side, we have the ANZ Roy Morgan Consumer Confidence Survey. This is a survey calculated monthly, which shows obviously how confident the average consumer is, and this index effectively has an average of around 114, which is shown by the red dash line. And as you can see, the consumer confidence is quite in the doldrums, and even worse, it appears, than the 07-08 GFC. You can see on the left-hand side the New Zealand GDP, so slightly negative last year. We're in technical recession. We are slightly above zero, so therefore we're out of technical recession. Now, the forecast going forward, this is showing the RBNZ forecast, shows that we will unlikely to get back to that 2% growth number until, I guess, H2 25, so the second half of next year. So things are positive, but only just. Turning now to the diversified funds performance, and we'll start with the income fund. So asset class performance was broadly positive in June as equities edged higher and global interest rates dropped on the face of weaker macroeconomic data. So total fund performance was plus 0.7%. Fixed income was the largest positive contributor as interest rates eased slightly. We had global equities returning plus 0.1%, and then Australasian equities contributed negative 0.1%. Looking at the individual positive contributors, within global equities, we had SAP up 12.4% and Novo Nordisk up 8.4%, and they were the top two contributors in June. SAP had a strong end of the month as markets reacted positively to the news of them publishing their open source manifesto. Novo Nordisk was buoyed on news from China that their semaglutide treatment for weight loss was approved for sale within the country. Domestically, Scalar Up Holdings was up 6.5% and a strong end of the month as the company announced leadership changes for both the CEO and CFO roles. As I mentioned, fixed income performed positively as rates drifted down on the back of weaker economic data, both domestically and also globally. Turning now to the negative contributors for the income fund, within Australasian equities, we had Charter Hall Group was down 7.8%, and this is as a result of the wider property sector struggling against a rapid repricing of interest rates in Australia, as the monthly CPI number came in higher than market expectations at the end of June at 4%. Within global equities, we had L'Oreal down 9.3%, and this dropped on guidance released from the company, indicating that growth rates for the beauty sector were going to be revised down on the back of weaker consumer backdrop globally, and also then continued volatility in trading conditions in China. Turning our attention to the growth fund. So the growth fund was up 0.9% for the month. Global equities contributed plus 0.8% of that. Fixed income contributed plus 0.2%, and then the only negative detractor was Australasian equities down 0.2%. Turning to individual contributors and looking at the positive ones, we had within global equities, SAP again up 12.4%, and Oracle Corp was up 20.5%. And markets reacted strongly to Oracle's quarterly earnings release in June. A strong generative AI demand boosted their guidance for the financial year 2025. Within Australasian equities, Scalar Up Holdings was up 6.5%, and CSL Limited was up 6.6%, and they were the top two performers for June. CSL bounced on improved prospects for their vaccine product line relating to avian flu. And again, fixed income performed positively as rates drifted down. Turning now to the negative contributors, we had within global equities, L'Oreal again down 9.3%, and GSK was down 13.4%, and they were the main detractors. L'Oreal dropped on guidance released from company management indicating the poor growth rates for the beauty sector. And GSK slid on news that a Delaware court found evidence of issues with its Zantac heartburn medication. Domestically, within Australasian equities, we had Megaport Limited was down 17.3%, and that was hit with negative sentiment around their upcoming earnings release and several analysts revising their price targets for the stock. That's all from me for this month. If you have any questions, please feel free to send them all through to info@mintasset.co.nz. Thank you very much.